Bill Gates caution, it is a certainty that we will have another financial crisis. Watch Before the Starvation. With elite investors like Michael Burry and Jeremy Grantham predicting a reckoning for today's overheated stock market, it might be time to look at dividend stocks. Today we're going to talk all about what Bill Gates predicts about the financial crisis and how to deal with this. So watch the video till the end, because today's video is going to be the bomb. Welcome to Investor Secret, your daily dose of wealth secrets. If you're interested in everything around big investors and their investment techniques, this is the place for you. Subscribe if you want to stay updated with all the investor secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. Dividend stocks are a way to diversify a portfolio that may be chasing growth a little too obsessively. They generate income in good times, bad times, and particularly important today, times of high inflation. They also tend to outdo the S&P 500 over the long run. One prominent portfolio that's heavy on dividend stocks belongs to the Bill and Melinda Gates Foundation Trust. With the trust being used to pay for so many initiatives, income needs to keep flowing into it. Dividend stocks help make this happen. Here are 3 dividend stocks that occupy significant space in the foundation's holdings. You may even be able to follow in its footsteps with some of your spare change. Waste management, WM. It's not the most glamorous of industries, but waste management is an essential one. No matter what happens with the economy, municipalities have little choice but to pay companies to get rid of our mountains of garbage, even if those costs increase. As one of the biggest players in the space, waste management remains in an entrenched position. The shares have more than doubled over the past 5 years and are up about 42% year to date. Management is projecting 15% revenue growth this year. Currently offering a yield of 1.4%, Waste Management's dividend has increased 18 years in a row. The company has paid out almost $1 billion in dividends over the last year, and its roughly $2.5 billion in free cash flow for 2021 means investors shouldn't have to worry about receiving their checks. Caterpillar CAT. As a company whose fortunes typically follow that of the larger economy, that'll happen when your equipment is a fixture on building sites the world over, Caterpillar is in an intriguing post-pandemic position. The company's revenues are feeling the effects of a paralyzed global supply chain, but still historically low interest rates and President Joe Biden's recently passed $1.2 trillion infrastructure bill mean there could be an awful lot of building going on in the US in the near future. Caterpillar's mining and energy businesses also provide exposure to commodities, which tend to do well during times of high inflation. The company's stock has ridden higher raw material and petroleum prices to an almost 15% increase this year. After announcing an 8% increase in June, Caterpillar's quarterly dividend is currently at $1.11 per share and offers a yield of 2.2%. The company has increased its annual dividend 27 years straight. Walmart WMT. With grocery stores deemed essential businesses, Walmart was able to keep its more than 1,700 stores in the U.S. open throughout the pandemic. Not only has the company increased both profits and market share since COVID coughed its way across the planet, but its reputation as a low-cost haven makes Walmart many consumers' go-to retailer when prices are rising. Walmart has steadily increased its dividends over the past 45 years. Its annual payout is currently $2.20 per share, translating into a dividend yield of 1.6%. After trending slightly downward over the past month, Walmart currently trades at roughly $136 per share. If that's still too steep, you can get a smaller piece of the company using a popular app that lets you buy fractions of shares with as much money as you're willing to spend. Look beyond the stock market. At the end of the day, stocks are inherently volatile, even those that provide dividends, and not everyone feels comfortable holding assets that swing wildly every week. If you want to invest in something that has little correlation with the ups and downs of the stock market, take a look at some unique alternative assets. Traditionally, investing in fine art or commercial real estate or even marine finance have only been options for the ultra-rich, like Gates. But with the help of new platforms, these kinds of opportunities are now available to retail investors too. How can you arrange your investments to withstand the next market crash? Stay put. A well-constructed plan will bounce back and expand nicely in time for a crash. Panicky investors like last year's stock unloaders now rue their decisions. Over the past 3 decades, the S&P 500 has grown 12-fold, not counting inflation. During that time, 3 major crashes occurred: the 2000 dot-com plunge, the 2008 financial crisis, and the 2020 coronavirus market panic. And yet those who hung on to their investments came out way ahead. Go heavy on stocks. Notice that crashes are mostly the realm of stocks. The paradox is that stocks, while risky, are the essential building blocks of wealth. Nothing appreciates as fast and over such long periods as equities. Think of them as protein, vital for growth and muscle function, but unhealthy as one's only food intake. Diversify well. A drop in one sector is offset by a rise or at least stability in another. But asset allocation requires care. Too often, people's portfolios are skewed. A recent Vanguard Group study found that median household had 63% in stocks, 16% in fixed income, and 21% in cash. That's far too much in cash, which pays almost nothing in interest, from bank savings accounts or money market funds. And likely this allocation has too little in bonds, whose interest rates are higher. The time-tested allocation is 60% in stocks and 40% in bonds. Understand bonds' role. You need that decent dollop of bonds for ballast when stocks nosedive, but don't look for much in the way of price rises from fixed income nowadays. Starting in the 1980s and until recently, bonds did fairly well. That's because interest rates were coming down and rates move in the opposite direction from bond prices. Now rates are on the way up. After a while though, bonds will likely keep you ahead of inflation, with a small bit of price appreciation thrown in. Favor index funds. By definition, they automatically follow the market, very often the S&P 500. That's why they charge lower fees than funds that actively pick securities. The so-called actives require well-paid staff to do the picking. For years, the S&P 500 has creamed actives. Lately, 82.5% of large-cap actives failed to beat the benchmark index. Get help. First, realize that everybody's circumstances differ. Your age, your expected retirement date, your family obligations, offspring's college expenses for instance, your location, Napoleon, Ohio is cheaper than New York City, and so on. Given all this, it pays to ask the pros to crunch the numbers for you, meaning financial advisors. The online advisor services like Betterment have low minimum investments, or for more tailored in-person advice, try firms such as Edelman Financial Engines. They can help fortify your portfolio. While talk abounds that a crash is coming soon due to the market's dizzying heights and various calamities like resurgent inflation, prognosticating one is not enough. As the great sage Warren Buffett put it, predicting rain doesn't count, building the ark does. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us the thumbs up. See you next time on Investor Secret. Bye!